Listen up. If you think the banking crisis of 2023 was just a blip, a little hiccup that got solved with some emergency loans and a long weekend, you need to see what's happening right now in the data that nobody's talking about. 3 weeks ago, a systemic risk model that accurately predicted the 2008 collapse started flashing red again. Not yellow, not orange, red. And the number it's showing? Banking sector stress levels we haven't seen since Lehman Brothers was erasing itself from existence. I'm talking about the SRISK model Systemic Risk Index. And if you've never heard of it, that's exactly the problem. Because while you're being told that everything is fine, that inflation is cooling, that the Fed has everything under control, this model is screaming that we're standing on the edge of something that could make 2023 look like a warm-up act. So today, I'm going to break down what SRISK is, why it matters, what it's telling us right now, and most importantly, what you need to do about it before the crowd figures it out. And if you want faster updates on this kind of systemic risk signal, the stuff that doesn't always make it into a full video, join my premium WhatsApp channel. Link is in the description. I drop voice notes, charts, and real-time alerts there first. Let's get into it. Here's what makes this story dangerous. It's not that the risk doesn't exist. It's that the risk is being measured, tracked, and quietly watched by institutional players while retail investors are left in the dark. The SRISK model, developed by economists at NYU Stern's Volatility Lab, measures something most people don't even think about. How much capital would the banking system need if we had another 2008-style crisis? Not if a single bank fails. Not if rates go up a little. But if the entire system experienced a 6-month equity market collapse of 40% or more, how much money would be required to keep banks solvent? And right now, the model is estimating that global systemically important banks would need over $450 billion in fresh capital to survive that scenario. That's more than double what it was in 2020. And it's approaching the levels we saw in late 2008 and early 2009. Let me say that again. The model that called the last financial crisis is saying we're back at 2008 stress levels. But here's the kicker. When you look at the headlines, what do you see? Soft landing achieved. Banking system resilient. Fed pivoting to rate cuts. The narrative and the data are moving in opposite directions. And when that happens, when the story and the math don't match, that's when you need to pay attention. Because in 2007, everyone was being told the same thing. Subprime is contained. Housing is strong. Banks are well capitalized. And then the model started screaming. And the people who were watching the model, they got out. The people watching CNBC, they didn't. Okay, let's break this down in plain English because if you understand this model, you understand the tripwire that could set off the next crisis. SRISK stands for systemic risk. It's a measure of how much capital a financial institution would need if we entered a systemic crisis. Specifically, a scenario where the broad equity market falls by 40% over 6 months. Think of it like this. Imagine you're a bank. You have assets, loans, bonds, securities, and you have liabilities, deposits, debt, obligations. In normal times, your assets are worth more than your liabilities, and that difference is your equity cushion. That's what protects you when things go wrong. But what happens when the market crashes? Your assets lose value. Loans default. Bonds get repriced. Securities fall. And suddenly, your cushion starts shrinking. If it shrinks too much, you become insolvent. You can't meet your obligations. And if you're a big enough bank, a systemically important bank, your failure triggers panic, contagion, and a cascade. SRISK calculates how much new capital each bank would need to stay above the regulatory minimum in that nightmare scenario. And here's what makes it powerful. It doesn't just look at one bank. It looks at the entire system. It measures interconnectedness. It tracks leverage. It monitors market valuation. And it updates in real time. So when SRISK is low, it means the system has enough cushion to absorb a shock. But when SRISK is high, like it is right now, it means we're one bad quarter away from banks needing emergency bailouts, liquidity injections, and extraordinary measures. In 2008, SRISK hit over $500 billion at the peak of the crisis. In 2020, during the COVID panic, it spiked to $300 billion. And right now, in early 2026, we're sitting above $450 billion and climbing. Now, does that mean a crisis is guaranteed? No. but it means the system is fragile. And fragile systems break when you least expect it. So why is SRISK rising right now? What's changed since 2023 when we were told the banking crisis was over? Let me give you the 4 pressure points that are quietly stressing the system. And if you're paying attention, you'll see how they all connect. Pressure point number 1, commercial real estate, the slow motion collapse. We've talked about this before, but it's getting worse, not better. U.S. banks hold over $2.7 trillion in commercial real estate exposure. And a massive chunk of that, office buildings, retail centers, older multifamily, is underwater. Delinquency rates on office loans are now above 8%, the highest since 2010. And here's the thing. Those loans were written when interest rates were near zero. Now they're refinancing at 7%, 8%, 9%. The math doesn't work. Buildings that were worth $100 million are now worth $60 million. And the banks holding those loans? They're not marking them to market. They're carrying them at fantasy valuations, hoping something changes. But hope is not a strategy. And when those loans start defaulting in size, and they will, especially as the 2026 to 2027 maturity wall hits, banks are going to take losses that eat directly into their capital cushions. That's SRISK pressure point number 1. Pressure point number 2, unrealized losses on bond holdings. Remember when the Fed jacked rates from 0 to 5.5% in 18 months? Banks that loaded up on long-duration treasuries and mortgage-backed securities during the low-rate era are now sitting on hundreds of billions in unrealized losses. As of Q4 2025, FDIC data shows U.S. banks holding over $500 billion in unrealized losses on securities portfolios. Those losses don't hit the income statement as long as the banks hold the bonds to maturity. But if there's a crisis, if there's a run, and they need liquidity fast, they have to sell. And when they sell, those unrealized losses become realized capital destruction. Silicon Valley Bank in 2023? That's exactly what killed it. A bank run forced them to sell bonds at a loss, which vaporized their equity. And guess what? The same vulnerabilities exist across the regional banking system today. That's pressure point number 2. Pressure point number 3, leverage and interconnectedness. SRISK doesn't just measure individual bank health. It measures systemic interconnectedness. How exposed is Bank A to Bank B? How much counterparty risk is floating through the derivatives market? How tight are the links between insurance companies, pension funds, and banks? And right now, leverage in the financial system is higher than it was in 2019. Derivatives notional outstanding is over $600 trillion globally. The repo market, the overnight funding mechanism that keeps the system liquid, has periodic stress events that require Fed intervention. When one institution fails, it doesn't fail in isolation. It triggers margin calls, collateral seizures, and forced liquidations across the network. That's pressure point number 3. Pressure point number 4, deposit flight risk in a digital age. In 1929, a bank run took days. You had to physically show up, stand in line, and demand your cash. In 2008, it took hours. But in 2023, Silicon Valley Bank lost $42 billion in deposits in less than 24 hours. Why? Because money moves at the speed of a smartphone app now. If confidence breaks, if panic spreads on social media, if one influencer says, "Get your money out," a bank can be drained before regulators even wake up. And here's the scary part. The FDIC insurance fund, the thing that's supposed to protect your deposits, has about $128 billion in it. Total insured deposits in the U.S.? Over $10 trillion. Do the math. If we have multiple bank failures at once, the fund gets overwhelmed fast. And then the Fed has to step in with emergency backstops, which means printing money, which means currency debasement, which means your purchasing power gets crushed even if your nominal balance is safe. That's pressure point number 4. And all 4 of these are live right now, stressing the system. Alright, so SRISK is elevated. The pressure points are real. But what does that actually mean? Does it mean banks start failing tomorrow? Does it mean we get another 2008? Not necessarily. Let me give you 3 scenarios, 3 ways this could unfold, and why you need to be prepared for all of them, even if you think scenario 1 is most likely. Scenario 1. controlled descent, the Fed steps in early. In this scenario, the Fed sees the stress building. Regional banks start reporting larger than expected credit losses. The stock market wobbles. And before panic sets in, the Fed announces a new emergency lending facility. Let's call it the Bank Term Funding Program 2.0. They offer banks the ability to borrow against their underwater securities at par value. They extend liquidity lines. They coordinate with the Treasury and FDIC. The message is, we've got this. No one needs to panic. And it works. SRISK stabilizes. The crisis is contained. Banks limp along zombie style, but the system doesn't collapse. That's scenario 1. And if you think this is what happens, you still need to be careful. Because even in this scenario, the cost is inflation. The Fed prints to bail out the system. The dollar weakens. And your grocery bill goes up while your bank balance stays the same. You didn't lose your money, but your money lost its value. That's the hidden tax. Scenario 2. Regional bank seizures, 2023 redux, bigger scale. In this scenario, the stress doesn't stay contained. A mid-sized regional bank with heavy CRE exposure reports a massive quarterly loss. Depositors panic. The bank gets seized over a weekend. Then another. Then another. The FDIC steps in, but the insurance fund starts running low. The Fed has to backstop the whole thing. Some depositors, those with balances over $250,000, take haircuts. Small businesses lose access to capital. Credit freezes. This isn't 2008. It's not Lehman scale. But it's messy, painful, and it hits Main Street harder than Wall Street because regional banks are the ones funding local businesses, real estate projects, and community development. That's scenario 2. And if you're sitting in a regional bank with a big chunk of uninsured deposits, you're the one taking the hit. Scenario 3, systemic cascade, the full SRISK nightmare. In this scenario, the crisis doesn't stay in banking. A major global bank with heavy derivatives exposure takes a catastrophic loss. Counterparties start pulling back. Margin calls ripple through the system. The stock market craters 30%, 40%. Credit markets seize up. The Fed, the ECB, the Bank of Japan, they all go into emergency mode. Rate cuts, QE infinity, coordinated currency swaps. And the system survives, but at the cost of currencies. Inflation doesn't just tick up. It explodes. Hard assets surge. Gold hits $4,000. Silver hits $120. Bitcoin either moons or crashes depending on how the liquidity flows. That's scenario 3. The low probability, high impact event. The one that SRISK is designed to warn you about. And here's the thing. Even if scenario 3 only has a 10% chance of happening, the cost of being wrong is so high that you have to prepare for it anyway. Now, I know what some of you are thinking. John, they've been predicting the next crash for years. It never happens. Why should I believe this? Fair question. And the answer is, you shouldn't believe it. You should prepare for it. Because here's the difference between now and all those false alarms. The policy room to respond is smaller than it's ever been. In 2008, the Fed could cut rates from 5% to 0. They had room to move. In 2020, rates were already low, but they could still print trillions and get away with it because inflation was dead. But now, inflation is still sticky at 3 to 4%. The Fed just finished a hiking cycle. They might get 1 or 2 rate cuts in 2026, but if a crisis hits, they can't go back to 0 without reigniting inflation. They're trapped between 2 bad options: crash or debase. And that's why SRISK matters more now than it did in 2008. Because in 2008, the solution was painful but clear. Bail out the banks, print money, stabilize the system. It worked. But the side effect, a decade of low rates and asset bubbles, set up the next crisis. Now, if they print again, the side effect is currency collapse. And if they don't print, the side effect is bank failures and credit freeze. There's no clean exit this time. That's the trap. All right, enough theory. Let's talk about what you actually do. Because knowing this information is useless if you don't act on it. Here's my 6-step action plan for navigating elevated SRISK risk. Step 1. Know your bank's exposure. Go look up your bank's quarterly call report. It's public. Google Your bank name FFIEC call report. Look for two things. Look for two things. First, commercial real estate loans as a percentage of total assets. If it's above 300% of capital, that's a red flag. Second, unrealized losses on securities. If they're holding hundreds of millions in underwater bonds, that's a warning sign. If your bank looks risky, have a plan B. Don't wait for the headline. Step 2. Understand FDIC limits and act accordingly. FDIC insurance covers $250,000 per depositor, per institution, per account type. If you have more than that in one bank, you're taking uninsured risk. Either spread it across multiple institutions or move excess funds into treasury bills directly through. At least then you're holding government debt directly, not bank counterparty risk. Step 3. Build a cash buffer. But don't overdo it. You need liquidity. If there's a crisis, you need to be able to access cash quickly without selling assets at fire sale prices. I'd recommend 3 to 6 months of expenses in a high-yield savings account or money market fund. But don't go overboard. Cash loses value to inflation. The goal is resilience, not hoarding. Step 4. Own hard assets as insurance. This is where gold and silver come in. Not as speculation, not as a trade, as insurance against systemic breakdown and currency debasement. If scenario 3 happens, if we get a full systemic cascade and the Fed prints trillions, your dollars lose purchasing power. Gold and silver don't. They're the assets that historically hold value when confidence in the system breaks. I'm not saying put 100% of your portfolio in metals, but 5 to 15%? That's prudent. That's the fire insurance on your financial house. Step 5. Don't panic into stupid decisions. Here's the trap. You watch this video. You see SRISK is elevated. You panic. You sell everything. You go 100% cash or 100% gold. And then scenario 1 happens, the Fed contains it, and you miss the next leg of the equity bull market. Don't let fear make you stupid. The goal is resilience, not panic. Diversify. Have a plan. But don't abandon rational allocation just because the risk is elevated. Step 6. Monitor the signals, not the noise. Watch these indicators. SRISK updates. NYU Stern VLab publishes them regularly. Bank credit spreads. If they start widening sharply, that's stress. Repo market rates. Spikes mean liquidity problems. The Fed's balance sheet. If it starts expanding again, that's crisis intervention. If these signals flash red together, that's when you move. Not before. Not after. When the data confirms the risk. So here's where we are. SRISK is at 2008 levels. The pressure points are live. The policy room is narrow. And most people have no idea this risk even exists. Does that mean a crisis is coming next month? No. Does it mean you should sell everything and hide in a bunker? Also no. But it does mean the system is fragile. And fragile systems don't give you much warning before they break. The time to prepare is before the crowd figures it out. Because once the panic starts, once the headlines hit, once the bank runs begin, it's too late to act calmly. Now, I'm going to keep tracking this. I'll update you if SRISK crosses critical thresholds. I'll let you know if banks start reporting bigger losses. And if you want those updates faster, voice notes, real-time signals, data I don't always put in videos, join my premium WhatsApp channel. Link is in the description. And here's what I need from you. If this analysis was valuable, hit that subscribe button. Comment SRISK down below so I know you're paying attention. Share this with someone who needs to see it. Because the more people who understand systemic risk, the harder it is for the system to hide it. The silver story didn't end at $91. The banking stress story didn't end in 2023. And the SRISK warning? That story is just beginning. Stay sharp. Stay prepared. And I'll see you in the next one.